Hello, welcome back to Core Finance. I'm Matt Brown. I'm joined by Craig Erlam, Senior Market Analyst at Oanda. And, well, look, this could be the last business, proper business week of the markets going into year end. So there's jam-packed. I mean, we're Wednesday already, but the business end certainly is at the end of the week. What are the highlights? What are moving the markets, and what are going to move the markets into the year end?
Yeah, I think you're right. I think this week is the last big week. We've got a number of central banks which are due to make announcements, and after this it does just start to fizzle out. We start to enter the holiday season, trading volumes are likely to ease off, and economic announcements, etc. are either likely to become much more thin or much less relevant. We've got the Fed tonight. That's probably the biggest of the central bank events this week because something's actually going to happen. So this rate hike is now almost entirely priced in. But there's also a lot more of interest to come from this meeting. I think while the rate hike itself is priced in, we may get some volatility around the actual announcement, assuming, of course, they push ahead. But then we also get things like the economic projections. So we find out, what do policymakers foresee for next year? Are we still anticipating 3 more rate hikes next year? What in terms of economic growth, inflation, are expectations the same? Have they been lowered? Which always has a big impact on the markets as well. We'll also hear from Janet Yellen, who will hold her press conference. But then there's still also a lot of gaps which are not going to be filled tonight. So it's going to be a case of how a market's going to interpret what we get. Because ultimately, Janet Yellen, come February next year, is gone. Jerome Powell is the new Fed chair. While he's likely to take the Fed in the same rough direction, it just means that you can only take what Janet Yellen says tonight with a pinch of salt. So how the markets interpret that's going to be interesting as well. There's also a number of vacancies to be filled on the actual FOMC itself, so people will have to make a mind up how that's going to go as well. So there's a lot to take from tonight, and it's going to be very interesting to see how markets respond to it. So I do personally expect we're going to see a lot of volatility around this event in particular. Then we've got the Bank of England ECB tomorrow as well, and I think they're going to be a bit of a non-event to a large extent because they both moved in the last couple of months. No rate hike expected from the Bank of England probably for another year at least. ECB's just extended its quantitative easing programme until the end of the third quarter next year. I think it's September, so they're unlikely to give us anything either. But we do have a press conference, and Mario Draghi loves to entertain.
Indeed, and with regards to just looking at the Fed, do you think they'll look at the dot plot for next year and take into account potential US tax reforms? Do actually the US tax reforms do anything for the US economy?
It all depends on which policymaker you're speaking to as to whether they're taking tax reform into consideration. And this is something we learned last year. So that's where it becomes interesting again, because all you see on these charts is a dot representing a particular policymaker. You don't get to see who chose which dot. So it's very difficult to say. I think people just look at the overall aggregate of the dots and assume that some form of tax reform is being priced in for next year. So that is going to have an impact. But ultimately, what we've seen in the past is the markets tend to take what the Fed projects with something of a pinch of salt. At the moment, the Fed's anticipating 3. I think if we get tax reform, we could see 3 or 4 rate hikes next year. Markets are currently pricing in 1 or 2. It'll be interesting to see how the markets respond to these projections tonight and whether that changes. But I don't think it's going to change too wildly, not to the upside anyway. If the Fed comes out and says we're now anticipating 2 rate hikes for next year, lower inflation and a bit lower economic growth, and markets I think will be very much on that, because markets seem to really get excited when the Fed backs down from what they are previously anticipating.
And well, look, one of the major asset classes of the year, and certainly a major talking point over the recent weeks again, is Bitcoin. I read an article today in the City AM saying in the US some people are taking out mortgages on their house, second mortgages on their houses to trade Bitcoin and invest in Bitcoin. Is that worrying?
It's certainly a red flag of a bubble. And I don't mean to keep going into this, because I think a lot of people are getting frustrated at the number of people who are calling Bitcoin a bubble, because ultimately there is something behind it. There's a very new revolutionary technology behind it, and you can completely understand that. That said, in '99, there was a lot behind the tech bubble. There was a lot of good things which came from the tech bubble, and while we did see a bubble and a crash after that, it's not like tech then went away. So when you say that these some things are bubble, you're not saying that the technology behind these things aren't sound. What you're saying is it's rallied far too much too quickly, and the rally has not been based on sound fundamentals. They've been based on FOMO, the fear of missing out trade. It's amazing how many texts I now get every day from people who have zero interest in financial markets, wanting to know about this Bitcoin thing and why everyone's making so much money from it and they're not. And this is a prime example of it. We had stories a few months ago of someone, I think in the Netherlands, selling their house and living in a tent with their family because they wanted to put everything they had in Bitcoin. Now, at the moment, they're probably laughing a lot harder than they am. They're probably sitting on a nice little nest egg and feeling quite smug right now. And maybe if these people who are taking out second mortgages, in a few months they may be laughing as well, but they may not be, because when prices rise this quickly, history suggests to us that they are going to crash as well, and the people who were laughing before may get out just in time. Alternatively, the people who were in laughing before, or maybe hoping that they're laughing in a few months' time, may just get caught right at the end. And like I say, it's hard to ever say when these bubbles are going to burst. It could be tomorrow, it could be in a month, it could be in 12 months. It's very difficult to say, but what you can say is the rise that we've seen in Bitcoin is absolutely not sustainable. Whether that tops at 20,000, 50,000, 100,000, we'll have to wait and see. But at least it's an enjoyable story for us to follow right now. And as I say, the technology underlying it is the most exciting thing. So that's something I'm really looking forward to following over the next few years.
Fantastic. Well, on that note, Craig Erlam, Senior Market Analyst at Oanda, thanks very much for joining us here on Core Finance.
Thank you.